the end of the year, you will see foreign portfolio investors wind down some of their India positions. To talk to them about what the year has been like and what the outlook continues to be on Indian equities, I have with me today OppenheimerFunds. It's one of India's oldest and largest foreign portfolio investors. This morning with us, Krishna Memani. He serves as Chief Investment Officer at OppenheimerFunds, and he oversees all of the investment teams at the firm. Though he personally manages more of the debt funds, he oversees all of them. Good morning to you, Mr. Memani. Let me start by asking you about the most important development we've seen regarding the global economy in the last few weeks, and that is the nomination of Jerome Powell as the next Fed chief. What do you make of that?
I think the nomination of Mr. Powell essentially tells us that the policies to be implemented by the Fed under his regime are pretty much going to be the same as Janet Yellen. I think that was one of the objectives of the Trump administration. Having somebody hawkish like John Taylor doesn't really help them from an economic or a political standpoint.
All right, that's a brief response. I have two further questions on global central banks, especially as you've called this in previous conversations, the century of central banks. Now, the Fed chief will change next year, as we know, as will the BOJ and the PBOC heads. That's one part. The other part, the great unwind has kicked off with the Fed. ECB starts to pull back next year, whereas the PBOC and the BOJ remain in unchanged positions. What does all of this add up to in terms of fund flows across the world in your assessment?
So I think if you look at the changes at the Fed chair may have changed, but the orientation of the Fed really has not changed and is unlikely to change in my view. So when I talk about the century of central banks, the point I'm trying to make is, given the demographics in the world, given all the other structural issues that we are dealing with on a global basis, monetary policy is going to be easy and supportive for a long period of time. Whether that ends up being 100 years or not, I don't know, and I wouldn't be around for you to throw stones at me. But I think it is quite likely, even with changes at the central banks in terms of personnel, the policies will continue the way they have been for the last 10 years.
And would you be just as sanguine about global economic growth and asset prices?
So global growth coming out of the 2015-2016 oil price commodity related collapse, the world is going through a synchronized global recovery, and therefore global growth is at its best level in a long time. I think expecting global growth to be at this level 2 years from today may be hoping for too much. So the growth outlook may get desynchronized. Having said that, I think the likelihood that we get into a recession anytime soon in the US, for example, or in developed markets, or in emerging markets for that matter, is pretty small in our judgment. And if that judgment is correct, then market prices can be supported, because overall, while growth may not be at the current level, growth will still be pretty good. Policy will be easy. Earnings continue to grow on a global basis. So we have fundamental and policy support for the markets at the moment.
Mr. Memani, you've gone on record in previous interactions to suggest that you don't think any of this will impact emerging market flows in any substantive fashion. Maybe I'm being a bit repetitive here, but I do want to put that question to you again. You don't think that emerging market equities will be impacted in any substantive way by this reversal in central bank policies?
I think the central banks would change their view on their domestic interest rate policy. And even if, for example, the Fed raises rates 3 times next year, I think it's unlikely, but even if that is the case, the net level of rates is still very supportive of overall growth trend. So as long as growth in emerging markets themselves is quite decent, which I think is going to be the case, and as long as growth in developed markets doesn't fall off a cliff, I think emerging market growth trends and markets should be supported, in my view.
You know, apologies for arguing this too much, but at one time the mere mention of a taper spooked EMs. Yet you insist that the actual unwind, not just the mention of it, the actual unwind will not hurt EMs?
So I think there certainly is a scenario under which things go really bad. And that scenario would be rates were raised very, very quickly and in unanticipated ways, unanticipated by the market. And the Fed is acutely aware of it, and ECB for sure is acutely aware of what the impact of that would be on a global basis. And I think that is part of their motivation, and the fact that inflation is missing in action and has been missing in action for quite some time. That's why they are being very gradual and cautious. And as long as that is the case, I think the net impact on flows coming back to the U.S., for example, from emerging markets, which will kind of tank the emerging markets, I don't think that is likely to happen. If you wanted to watch one metric, one weather vane in the market to figure all of that out, I think dollar is the perfect tool. That's one metric you can look at, and as long as dollar remains at its current levels or tightened or goes up only modestly, as long as that is the case, I think we remain in good shape. If that changes and dollar appreciates 15–20% and gets back to the level of, let's say, 12 months ago, I think then we are going to have some problems.
All right, I've read your comments on our website, BloombergQuint.com as well, and I think you've stated that you expect the dollar to stay within the range of where it is right now. I will talk about the rupee as well in just a bit, but before that, let me move to talking about Indian equity markets. They've run up and run hard this year, up between 25 to 30% on key indices. There is some talk that maybe there is the case to be made for overvaluation. What's your assessment?
So I would say Indian equity markets are probably going to get supported at current levels, both from a domestic standpoint and from a international standpoint, because emerging markets are in vogue. So I don't think there's anything special about the Indian markets per se. You know, in India, growth is being challenged. I think the growth rate is not where people would like it to be, and it's softening at the margin, and that's not a good thing. And I think it'll have consequences for earnings as well. But as long as the dollar is soft and as long as the valuations in the U.S. and other developed markets remain elevated, money is coming into emerging markets, and some of that money ends up being in India. And for Indian domestic investors, I think this is a multi-decade trend where we went through that in the U.S. from 1970 to today, which is equitization of people's portfolios. And as long as that is the case, I think domestic flows into domestic equity markets will probably remain good, with some gyrations here and there. But from a long-term trend standpoint, that is going to be supportive of Indian markets. The challenge for India is to find ways of not inflicting pain on their own economy. And every so often we find ways of doing that, I suppose.
All right, I suspect you're referring to some key decisions made in India regarding demonetization and maybe even the implementation of GST. I won't get into that at this point in time, but what I do want to ask you right now, since you spoke of the dollar, the rupee is up some 5% this year. What's your view on where the currency is headed and how that will impact Oppenheimer's opportunities in debt and equity in India?
So I think, again, the rupee appreciated not because there was anything special about India per se. Indian economy was growing relatively well, and it was expected to grow relatively well. I think the rupee was appreciating because monies were coming into emerging markets, and India is a large destination for emerging markets. My view would be that if the Indian economy continues to slow, and I think there's a reasonable case to be made for that. If that's the case, while we may say that there's not a whole lot of room to cut rates, especially given the direction of fiscal policy, I think at some point we will have to reevaluate that unless the economy can come back from its current slump. The driver of rates and inflation and currency to some extent are going to be driven by what is happening in the economy, and I think we need to ask that hard question whether that assumption is correct or not at the moment.
Has your exposure to India changed in any big material way in these past few months?
So I think given Indian valuations and given the direction of the Indian economy, we clearly have not increased our exposure. If at some point valuations correct meaningfully or Indian rates become attractive all over again, we will take advantage of that opportunity as we have done in the past.
All right. I was looking through your list of top holdings. I know you don't like answering stock-specific questions, but I'm going to hazard putting one to you anyways. Your top India investments include stocks like HDFC, Z, Infosys, Kotak Mahindra Bank, Biocon. What is the approach here? What has it been in the recent past, and has it changed?
Our approach for investing in international equities and Indian equities just as much is to not focus on specific industries or specific sectors of the economy as much as it is focusing on specific companies and management teams, and where we think the opportunity to execute is extraordinarily good. And if you execute the management plan, valuations are attractive enough so that the upside is quite substantial. That's how we approach it. It's not because we like the entertainment sector or we like the banking sector. We may, but that's really not the primary driver. The primary driver is, take HDFC for example. The primary driver is a fantastic management team that has been executing consistently over a long period of time. That's what we are looking for in an investment.
Well, then, can I ask you about Infosys? Since you've mentioned HDFC, your fund manager wrote a letter to the Infi board in the last few months when the Vishal Sikka controversy was underway. The letter extended support to Sikka's leadership. It called for an end to the divisiveness. You continue to be confident on Infi and have a substantially large holding, at least within your portfolio, despite this leadership crisis. Since you are talking stock specific, why stay invested in Infi despite, the position that you've held earlier?
So Infosys is a good example. I think without getting too deep into the specifics of things, we think it is still a very good company with Vishal or without Vishal. The footprint of the company, the capabilities of the company, the opportunity that the company has to execute its plan is fantastic. It's one of the best out there in the business, and valuations are very attractive. So it's a combination of factors, and we remain invested in the company because we think the future of the company is quite good, and whatever management changes take place, we evaluate it, and the conclusion that we have come to is it's something that will sort itself out in the long run. The company's capabilities and the company's footprint and customer base, all of those things are very, very attractive.
Curiously, you have just one NBFC in your top picks. That's Chola. Are you all not big fans of this sector as others have been?
So without getting into specific names and talking about them specifically, again, I would come back to my initial assertion. We evaluate a lot of companies in India, and where we think the opportunity is extraordinarily good from a management team standpoint and the strategy that the company is implementing. If those opportunities present themselves in any sector, we would be a participant in that investment. It's really very, very company specific rather than sector or anything like that for us.
All right, I get the message. One final question then. Given how hard we've run in India, do you expect to see a pullback anytime soon?
So I think for a significant pullback, the global trend into emerging markets has to reverse itself. As long as that is not the case, and that is not our base case, I think Indian markets remain supported, irrespective of kind of minor slowdown in the Indian economy. If the slowdown in the Indian economy is far more than what we are anticipating at the moment, then it's a different ball game altogether. Given our outlook on the Indian economy today, and given our outlook on emerging markets in general, I think if there is any pullback, it is going to be a modest pullback. And my hope and my expectation is that Indian growth stabilizes rather than keeps careening off the path that has been for a while.
All right, Krishna Memani, thank you so much for joining us this morning and for those insights into the Indian equity markets.